and welcome to a brand new episode of Smart Money. Now, there's one category of funds that is bridging the gap between active and passive funds. It's called Smart Beta funds and is gaining traction now. A Smart Beta index fund operates as a passive investment vehicle, tracking an index that selects stocks using a specific strategy. In essence, these indices draw stocks from broader indices like the Nifty 50, Nifty 100, Nifty 200, employing criteria like low volatility, quality metrics, momentum and dividend yield. But why are we talking about this? It's because there's a lot of traction that's now picking up in some of these categories. To talk about how you can use Smart Beta funds in your investment journey, we have with us Swarup Mohanty, the Vice Chairman and CEO of Mirae Asset Investment Managers. Swarup, always a pleasure having you here with us on CNBC-TV18.
Sonia, thank you so much for having me on your show. It's doing so well. It's a pleasure being on your show today.
Thank you. I mean, we just want to educate our viewers about several topics, and I'm glad we picked this because it's a fairly recent, addition to the entire mutual fund space. Just for people who have no idea about it, can you explain to us what is the concept of Smart Beta investing? How does it bridge the gap between passive and active investment strategies?
See, I think when you look at the globe in late 60s, it was all about inefficiency in the market. So alpha generating was fairly possible. So the 60s was all about active investing. Towards the end of the 80s or 90s, then people realized that in this pursuit of trying to get returns above the market, the risk of underperforming the market was also large. Hence, that gave birth to the upswing in passive investing, which is like buying the market. And then towards the late 2000 or the beginning of the 2000s, then came the fact that why don't we get in some of these active strategies into the passive side and form some rules around it. Like you mentioned, on volatility, on momentum, on quality, and hence form a very sustainable rule-based approach to investing over the passive indexes. Suppose there is Nifty 50, which broadly showcases the market, and I add a certain rule above Nifty 50 and say, okay, let me give you the alpha stocks which I think are in Nifty 50, or say 30 stocks among now the top 100, which I think can be far higher alpha generator than the broad 100 stocks. So you can then form a rule on it, and that gave birth to what we call Smart Beta, or what we call factor investing.
But that again then defies the purpose of investing into passive funds, right? Because see, in an active fund, what you have is this fund manager bias as well. There are several other things that go into an active fund. The reason I'm moving to a passive fund is because I just want to purely benchmark the index. Then how does Smart Beta come into play?
There are two types of investors. I mean, the first investor, like I rightly said, realizes that in this process of trying to beat the market is the possibility of underperforming the market, and does not want to take that underperformance risk. So hence he or she picks the passive fund, which is the broad market cap indices. But there are those people who say, okay, fine, the fund manager comes with some subjectivity. I would like to move to a rule-based category, and that's where the brilliance of Smart Beta comes in. Because what will happen is, when it comes to the same kind of connotation between active and Smart Beta, say the same fund manager might be looking at quality, but there comes that, like you rightly said, subjectivity. Might apply it, might not apply it, but in a factor, it will apply. So once you read up what a factor does, and then the essence or the brilliance of rule-based investing over a period of time has its own merits, and that's how factor investing over a period of time is gaining fair amount of traction globally. We are seeing the birth of it in India. As it starts building its own track record, you will see that people will probably choose this as one of their choices in their investing portfolios.
So currently, are there any Smart Beta funds? And if yes, what is the size in the Indian market currently? And how do Smart Beta indices compare to active funds in terms of the stock and sector exposure?
See, I think broadly both mimic the same kind of approach. Active investing and Smart Beta investing are practically the same approach. The only difference between being that the active investing comes with its subjectivity of the fund manager, which may or may not apply. It depends on the fund manager's choice. But when it comes to Smart Beta, for the sake of repetition, it is rule-based, hence it will always apply. Just to give you an example, suppose we are talking about, say, now it's better to talk about small caps because that's what is in everybody's mind. Now, the big factor that comes in is, say, the liquidity of small cap stocks. That's also been in vogue in discussions like that. Here, it will apply a liquidity filter and thrash out all the liquidity. What happens is, first there is an elimination of stocks as a process. And when you apply the factor, then the selection of stocks, then the weightages. Suppose I say, in that I will only take 3% weight per stock. and hence the weightages are applied, and then the portfolio happens. It's a laid out process which is bound to happen. So though essence of both the approaches are the same, but the probability of taking those stocks definitely is more in the smart beta side than in the active side.
Are you also talking about, I was also asking you about how many such funds there are in the market currently, right? And how big is the size, the opportunity size according to you?
It's just the beginning. I think we're around 18,000 crores as we speak, but growing by the day. Like I said, as the track record starts building, people will realize the power of a rule-based investing. And we see this space growing because fact is, Indian investors are still yet to get out of the alpha generation phase. So I do suspect that since, and to be fair to us, we've watched this story unfold globally. So we are able to pick and choose some of the good factors that are there globally, apply them, or I think, jump to that rather than go through the rigors that the global markets have gone through. Correct. So I think growth of smart beta will be quicker than that of the globe is my suspicion. As we speak, I think around 18,000 crores of assets roughly under management, but I won't be surprised it starts doubling very quickly.
It's still quite small that way.
Yes.
Less than 20,000 crores in smart beta investing. Okay, you were telling us about some of the similarities and differences between active fund managers and smart beta strategies, right? In terms of investment styles, investment performance across market cycles, any more that, differences that you want to add?
I think both will be cyclical. I think when you look at both the styles, suppose earlier in our simplified active management days, we used to have growth and value. So there were long cycles when value wouldn't perform and growth guys would hit the NAVs higher than say the value guys. But as we speak, suddenly there has been a turn in the last 2 years. The erstwhile value looks like growth and the growth guys look like value. So similarly, when you apply factors, they are also cyclical in nature. Sometimes, say in bearish markets, we've seen value doing well. Say in bullish markets like that, you will see momentum doing well. In long stretches of bearishness, you will see quality doing better. So it depends on what factor you apply, and I would really request all investors to read all those factors before investing, and hence they will get a more clarified, approach to what they can pick and choose. Okay. Sometimes it's a combination of many factors also, like, you can put liquidity, you can put quality together and combine it to make a better sort of outcome.
So Swarup, for someone who's in this age group of say 25 to 40, right, 25 to 35, what should the best allocation be, strategy be between active funds, passive funds and smart beta funds? What's the best way to approach it?
See, finally there is no difference in the approach. The approach, I still maintain that the approach has to be goal based. Based on your goal forms your portfolio. And now an active investing and a factor practically are the same approach. If you take out the subjectivity of the fund manager or the skill of this fund manager or the expertise of the fund manager and replace it by a rule, that's where is the difference. Otherwise, I don't see any I don't see any change in the approach to selecting what should be better. Depends on the individual. I think I would really at this moment look at factor investing through large distributors of advisors, because it's the starting point in selecting which are the right factors which will cater to the risk profile of the investor. But the formation of the portfolio, the values or the rules that go into formation of the portfolios remain the same of active versus factor investing.
Okay. Can you explain the concept of active share and how that applies to smart beta products?
See, I think when you look at active share, if you're looking at say Nifty 50, right? How much of that 50 is in that stock is what would form the. You'll be surprised to know that in factors, the active shares tend to be higher than a lot of, active fund management. And that's how, factor investing has become popular globally, because the active share of the underlying sometimes become far higher than what happens. Or suppose when you look at, say momentum as a factor, So the number of momentum stocks, because it is role based, will always be higher than say anybody who's put it on a subjective manner, is my simple point.
Okay. And what about portfolio churn? How does that happen in smart beta indices and compared to that of active funds? Because, I believe that this fund manager bias is something that it's real, right? I mean, for example, I've been investing in this market for over 15 years, and there are so many funds where I started investing based on one fund manager's expertise. Over the years, that fund manager has left and gone, and I was left wondering, what do I do next? So as time passes, I'm sure this this whole fund manager issue will be resolved? There's so much AI now, there's so much quant investing as well. So what factors should investors consider when they choose, these smart beta funds?
So the great John Bogle has said that the index is perpetual, right? And that's the beauty about making it rule-based, that the rule is perpetual, right? But at the end of the day, if you look at it from an Indian market perspective, you still can't take away the expertise of brilliant fund managers in the market. So at this moment, the investor is spoiled for choice. He or she can choose great fund managers with great track record already in the market.
No, that's not my question. My question is, of course, fund managers are great, but everyone has a life cycle, right?
That's what I was coming to.
Leave.
Yeah. So, but at one point of time, these changes do happen, and that history of change is there in front of you. Now, if you believe the way to go ahead is active, please choose it. But the simpler way is to apply the factor. The rule will always be persistent, and the rule will play out. So, to answer your question on churn, typically the churn of factors and active is very similar. I would suspect the churn of factors can be higher because it will definitely apply the rule on the rebalancing day. But for the investor, the churn has no meaning because when you take away the cost of active management, most of the factor funds will come at a far cheaper price than the active fund management.
Okay. Can you provide some examples of, how smart beta indices have performed historically in several markets? Because it's still a nascent concept here. So, historically, how have the returns been?
See, my best example is always the Alpha 30. If you look at the Alpha Nifty 200 Alpha 30, the Alpha 30 has outperformed all practical funds in those respective comparisons on any horizon. You can check that out because, again, bringing out the merit of the rule-based investing over a period of time. It does go through its cycles, ups and downs, but when you spread it over a period of time, the Alpha 30 has distinctly outperformed most of the market.
Okay, we'll talk more about that in a bit. We'll also take a short commercial break. Don't go anywhere. We'll come back with Swarup Mohanty to talk more about smart beta investing and, of course, what his view is on the overall market. Stay tuned.